Usually, when we talk about corporate earnings calls with you, there is this expectation of just like profound boredom.
Oh, absolutely. I mean, they're notoriously dry.
Right, like reading the terms and conditions on a software update or something. It's just a wall of financial jargon, executives reading from carefully sanitized scripts, and a barrage of numbers that feel, I don't know, completely disconnected from anything resembling reality.
Yeah, the entire format is practically designed by corporate lawyers to be as unremarkable and sleepy as possible. Minimize risks, stick to the script.
But then you stumble across a document like the one we were looking at today, and suddenly that boring conference call transcript reads less like a spreadsheet and more like, well, a secret recipe for survival.
It really does.
Because today's deep dive, our mission for you, is taking a raw corporate document, specifically excerpts from a Q1 2026 earnings conference call for a major financial platform, SoFi, and we're going to translate that jargon into a masterclass.
Right. We're looking at how a modern business builds this massive financial flywheel.
Exactly. Balancing incredible growth with risk and the sometimes harsh realities of accounting, all while the broader economy is just completely unpredictable right now.
Because, that is the real trick in finance. I mean, anyone can make money when interest rates are practically zero and the economy is booming.
Right, the money is free.
Exactly. The money is free, borrowers are flush. But making money when the macro environment is actively hostile, like when interest rates are stubbornly high, that requires a very specific, deliberate architecture.
Okay, let's unpack this. To really understand the health of any business, you have to look at the actual money coming through the door versus what is just written down on paper as a theoretical game.
Yeah, the difference between cash and accounting fiction.
Right, and the headline numbers for this platform are massive. In the first quarter of 2026, their adjusted net revenue grew 41% to $1.1 billion.
Which is huge.
And this was their 10th consecutive profitable quarter.
I mean, it's a level of profitability that just forces you to pay attention. They reported a net income of $167 million.
Yeah, and their earnings per share, their EPS, was 12 cents. But what stood out to me in the transcript, the really interesting part, was that this EPS would have actually been 13 cents if not for a very specific, like 1 cent hit.
Right, the tax thing.
Exactly. They had a decrease in tax benefits related to employee stock compensation. And it was literally just because the share price fluctuated between the end of 2025 and the beginning of 2026.
You are hitting on a vital quirk of corporate finance here. A simple stock fluctuation, something the day-to-day operations team has literally no control over, can shave a penny off the reported earnings per share.
It's crazy.
It distorts the operational reality. The company is doing great, but a random tax rule makes the bottom line look slightly weaker. This is exactly why paper accounting can be incredibly frustrating for investors to decode.
Which makes the chief financial officer's next move so brilliant, I think.
Yeah.
The CFO explicitly disclosed to investors that they generated $1.1 billion in cash revenue.
Emphasizing the cash.
Right. When I read that, I had to stop and think about the phrasing. Why emphasize the word cash? It's kind of like trying to explain to your partner how much money you made this year.
Oh, that's a good way to look at it.
Right, because you could give him your total compensation number.
Yeah.
That includes your base salary, your 401k match, and maybe some unvested stock options that you literally cannot touch for 4 years.
Right, a fantastic number on a piece of paper.
Exactly. But your partner doesn't care about the paper. They just want to know, okay, but how much money is actually sitting in our checking account today, free of IOUs?
That is the perfect analogy for what the CFO is doing here. What's fascinating here is the mechanics of why they had to make this distinction for Wall Street.
Okay, break that down for us.
So that $1.1 billion in cash revenue breaks down into two main buckets. You have approximately $690 million from net interest income.
The interest from loans.
Right, the cold, hard cash they collect from the interest on loans. Then you have about $390 million from various fees. Things like interchange fees when people use their debit cards, brokerage fees, loan platform fees.
But wait, isn't all revenue technically cash eventually? Like, why is there such a massive gulf in banking between paper revenue and cash revenue?
It comes down to a fundamental rule in banking called mark-to-market accounting.
Okay.
Let's break this down. Normally, if you own a hardware store and you buy a hammer for $10, it sits on your balance sheet for $10 until you sell it.
Makes sense.
But with mark-to-market accounting, you have to constantly revalue your assets. in this case, your loans, based on what the current market would pay for them today.
Oh, so if interest rates shoot up or the broader economy gets shaky, the value of the loans on their books is constantly wiggling around, even if the borrower is still perfectly on time with their monthly payments.
Precisely. And it gets way more complicated when a platform is growing fast. When a company like this originates a brand new loan, they often record upfront non-cash premiums.
Non-cash premiums.
Right. Basically, accounting rules say, hey, you just created a really valuable asset. You need to record a portion of that future value right now. So it goes down as revenue on paper. But the cash hasn't fully arrived yet.
Because the borrower is going to pay that back over 3 or 5 years?
Exactly.
I see. So if you are growing aggressively and issuing a ton of new loans, your balance sheet looks incredibly inflated with these non-cash premiums. Like, you look rich on paper, but you might be starved for actual cash.
You nailed it. That mismatch is the death knell for a lot of fast-growing fintech companies. But the CFO noted a massive milestone in this Q1 call. Their cash revenue streams are now nearly equivalent to their total reported adjusted net revenue.
Because the company has finally matured. I mean, they've built up enough older loans to balance out the new ones.
Yes, it's about scale and seasoning. They have an older backbook of loans that are steadily churning out real cash and amortizing.
Right.
That cash flow is now large enough to completely absorb the accounting volatility and the paper premiums of the new front book of loans. Yeah. Over the life of the loan, the fair value accounting and the cost accounting completely converge.
So the machine is finally big enough that the timing smooths itself out. They're generating cold, hard cash, not chip paper promises. But, that $1.1 billion in cash isn't just spontaneously appearing in their accounts. It's the exhaust from an incredibly active engine.
A very specific kind of engine, yeah. They are acting as a highly efficient routing system for global capital.
Let's look at the sheer scale of the demand they are processing, because the Q1 origination numbers are staggering. In just 3 months, they originated a record $8.3 billion in personal loans.
Insane volume.
Student loans hit $2.6 billion, which is up 2.2 times from the exact same period last year. And home loans hit $1.2 billion, up 2.4 times year over year.
The demand is exceptional, especially considering the current macroeconomic constraints. But generating demand isn't the true genius of their model.
No.
No, the genius is what they do with those loans the second after the borrower signs the paperwork.
Wait, hold on. If these loans are performing so well, and they are generating so much massive demand, why wouldn't the company just keep all $8.3 billion of those personal loans on their own books?
That's the obvious question, right?
Right. I mean, if I build a machine that prints highly profitable debt, I want to collect all that long-term interest for myself. Why hand that profit to someone else?
It's a completely logical assumption. If a loan is good, you keep it. But keeping every single loan on your balance sheet means tying up every single dollar of your capital. It also means taking on 100% of the credit risk. If the economy completely tanks tomorrow and unemployment spikes, everyone defaults, and you take the full catastrophic hit. The core strategy they deploy to prevent that is what they call optionality.
Optionality. Having the freedom to pivot.
Let's look at how they applied it. Out of that record personal loan volume, they kept nearly $5.4 billion on their own balance sheet. As you pointed out, that generates much stronger revenue over the life of the loan.
Right, they keep the best stuff.
But they didn't keep it all. They purposefully routed approximately $3 billion through what they call their loan platform business, or LPB.
So what is the mechanical difference there? Like, what does routing it through the LPB actually do?
It acts as a pressure release valve that generates capital light fee income.
Okay.
The platform originates the loan, meaning they do the marketing, the underwriting, the customer service, but then they immediately pass the actual loan to a partner institution.
So they collect a healthy fee for playing matchmaker.
Exactly. But they retain zero credit risk, no loss share agreements. If that borrower defaults 3 years from now, the platform is not holding the bag.
You get paid handsomely to set up the marriage, but you don't have to live with the couple if things get messy.
That is exactly it.
And the text notes, they're attracting some absolute heavyweights to buy these loans. In Q1 alone, they added $3.6 billion in new commitments from 3 massive partners.
Very serious partners.
Yeah, we're talking a leading global bank, a prominent insurance group, and a top 5 global private asset management firm.
This cannot be overstated. These aren't just speculative day traders buying debt. These are some of the most sophisticated, risk-averse financial institutions on the planet.
They know what they're doing.
Right. They have armies of analysts scrutinizing the credit quality before they buy. This dual-channel approach, keeping the most strategic loans for long-term yield and selling the rest for immediate risk-free cash, it allows the platform to maximize its returns regardless of the economic weather.
So if their own capital is tight, they sell more to the global banks.
Yes,
If they have a mountain of excess deposits, they hold more themselves.
precisely.
But, no global bank is going to blindly buy $3 billion in loans unless the foundation of that debt is made of reinforced concrete. Like, if you were originating and moving billions of dollars, the risk of defaults is ever present. Who exactly are they lending to?
It all starts with a surprisingly strict baseline regarding their borrower profiles. These are highly insulated consumers. According to the transcript, the average personal loan borrower on their platform makes $154,000 a year and has a weighted average FICO score of 745.
Wow, that's essentially super prime.
It is, and it's even stricter for student loans. Those borrowers average $161,000 in income with a 767 FICO score.
That is massive.
They were talking about high-earning professionals, people who likely have deep emergency savings, stable white-collar jobs, and a deeply entrenched history of paying their bills on time.
Okay, so the borrowers are highly qualified, but there is a specific move they made in Q1 regarding these loans that immediately made the hairs on the back of my neck stand up.
Uh-oh.
Yeah. The CFO mentioned they executed a $919 million securitization of LPB loans at an 86 basis point spread. Now, I consider myself a pretty rational person, but when I hear words like securitization and tranches bundled together, my mind immediately flashes to the 2008 financial crisis.
Oh, I get it. It is a very visceral reaction for a lot of people. Securitization became a profoundly dirty word after the subprime mortgage meltdown.
Right. So how is this different? The CFO boasted that they kept a 5% vertical slice across the tranches, but importantly, they did not retain any first loss or horizontal risk position.
Lots of jargon there.
Yeah. Can you translate that into plain English? Because horizontal risk sounds like Wall Street dark arts designed to hide something terrible.
Let's completely demystify this. Securitization is really just a fancy word for bundling. You take a pool of thousands of individual loans, in this case, $919 million worth, bundle them into a single massive package, and sell pieces of that package to investors.
Yeah.
But you don't sell it evenly. You slice the bundle into different layers or tranches based entirely on risk.
Like a financial Jenga tower.
Exactly like a Jenga tower. The top blocks of the tower are the absolute safest. The investors who buy the top layer get paid back first before anyone else.
Got it.
Because it's so safe, they accept a very low interest rate. The bottom blocks of the tower bear all the weight and all the risk. They get paid back last. So the investors who buy the bottom layer demand a much higher interest rate to compensate for that danger.
Okay, so where does the 5% vertical slice come in?
Right. So after the 2008 crisis, regulators stepped in and said, if you are going to build and sell these Jenga towers to the market, you cannot just wash your hands of them. You need skin in the game. You must keep a 5% slice.
That makes sense.
A vertical slice means the platform takes a proportionate 5% sliver of every single layer of the tower, from the ultra-safe top to the risky bottom. They share in the exact same risk profile as their investors. They're eating their own cooking.
But wait, the CFO explicitly said they took absolutely no horizontal risk.
That is the masterstroke. The horizontal risk, often called the first loss position, is the absolute bottom layer of the Jenga tower.
The riskiest part.
Right. If even a handful of borrowers default, that bottom horizontal layer takes the financial hit before anyone else. It completely absorbs the initial shock. By stating they have zero horizontal risk, the CFO is confirming that they successfully convinced outside investors to buy that riskiest bottom layer.
Oh, meaning the platform itself is totally insulated from those initial first-dollar losses.
Yes.
They proved to the open market that their $154,000 a year borrowers were so reliable, massive financial institutions happily bought the riskiest part of the pool.
If we connect this to the bigger picture, you can see this disciplined risk management echoing through all of their performance data. It's not just theory, it's showing up in the real-world defaults.
Right.
They reported that their estimated all-in annualized net charge-off rate for personal loans was 4.4%.
Just to clarify for everyone, a charge-off is a loan the company has officially decided is uncollectible, like they've accepted it as a loss.
Correct. And that 4.4% rate is actually flat from the previous quarter and down from a year ago. That alone is impressive. But it gets better when you look at their internal buffers.
Okay.
They modeled their entire business architecture around a 7 to 8% life of loan net cumulative loss tolerance. That 8% is their absolute worst case scenario.
Or they get anywhere near that ceiling.
Nowhere close. The transcript data shows that their recent vintages loans originating from Q4 2022 through Q2 2023 currently have cumulative losses of just 4.64%.
Wow.
And here's the kicker. 36% of the principal on those loans still remains to be paid down.
So the loans are mostly paid off.
Yeah.
And they've only taken a 4.6% hit.
Right. For that specific group of loans to ever hit the 8% disaster limit, the charge-off rate on the remaining balances would have to suddenly and inexplicably spike to around 10%.
Which they know would be wildly above any historical precedent for loans at that mature stage of the life cycle.
Exactly.
They've essentially planned for an 8.0 magnitude earthquake, and they're currently just experiencing a slight breeze.
It's a fortress. In fact, their older 2017 cohort of loans was experiencing 6.32% losses at this exact same point in their life cycle.
Wait, really?
Yeah. So their newer post-pandemic loans are actually performing significantly better than their pre-pandemic underwriting.
So the foundation is strong, the routing engine is humming, and the risk is packaged away perfectly. But it's easy to build a perfectly balanced Jenga tower in a vacuum.
True.
They are operating in the real world, dealing with a broader, potentially hostile economic environment.
This is where their strategy faces the ultimate stress test. Everything we've discussed so far is internal mechanics, but the external forces are brutal right now.
Because there was a massive macroeconomic bombshell dropped in this earnings call.
Yes, there was.
The CFO stated point blank that they are now modeling their entire 2026 business outlook on the expectation of absolutely zero interest rate cuts this year. None.
Zero.
They are betting that the cost of borrowing is going to stay painfully high all year long.
Which is a remarkably conservative, pragmatic stance. I mean, half the financial sector spent early 2026 praying for the Federal Reserve to cut rates and bail out their profit margins.
And this platform just accepted reality and adjusted. Here's where it gets really interesting. Despite operating in a high-rate environment where borrowing money is incredibly expensive, their net interest margin, or IN, actually grew sequentially to 5.94%.
It's a massive number.
Right. Now, IN is just the difference between the interest they earn from borrowers and the interest they pay out to their depositors. Expanding that margin while benchmark rates are frozen high is incredibly difficult. Like, if rates are high, shouldn't their cost of funding these loans also be sky high? How are they expanding their margins?
It all comes down to where they get their raw materials. They aren't relying on expensive wholesale borrowing from other massive banks. They are sourcing their funds directly from their own retail members.
Oh, I see.
Total member deposits grew by $2.7 billion in just one quarter, reaching over $40.2 billion.
Over $40 billion in member deposits.
Because their platform is so attractive to consumers, they pull in a tsunami of direct deposits. Let's use an analogy.
Let's hear it.
Imagine you run a bakery. Everyone else has to buy their flour at retail prices from a middleman. So when inflation hits, their costs explode.
Right.
But you convinced local farmers to store their wheat directly in your silos in exchange for a modest fee. Your cost of goods sold remains incredibly low, even when the market price is high.
So even though national benchmark interest rates are high, their actual cost to fund new loans decreased by 25 basis points in the quarter.
Exactly.
Their flour is cheap, but they are selling the bread at premium market rates.
That's exactly it. And this dynamic explains why their fair value marks are so staggering. At the end of Q1, their personal loans were marked at 105.4% of par value, and their student loans at 105.2%.
Let me make sure I understand that. 105%, meaning the loans sitting on their books are technically worth more than the original amount they lent out.
Yes. Think of it like buying a vintage guitar. You paid $1,000 for it. But because it produces a sound nobody else can replicate right now, collectors are willing to pay you $1,050 for it today.
Wow.
These loans are yielding high interest rates. The weighted average coupon, or WAC, remains very strong, and default rates are incredibly low.
Yeah.
At the same time, prepayment rates have actually decreased modestly.
Meaning borrowers aren't rushing to pay off the loans early, so they are generating that high interest for a longer period of time.
Exactly. The loans are highly profitable, incredibly stable, and generating long-term yield. The open market values them at a premium.
Okay, we have waded deep into the weeds of securitization tranches, mark-to-market accounting, and net interest margins.
Yeah.
So what does this all mean for the listener? Why should someone prepping for a meeting or analyzing a business or just trying to be an informed consumer care about this company's guidance for the second quarter of 2026?
Because it is a masterclass in long-term operational resilience that any professional can learn from. Look at their Q2 guidance. They are projecting roughly 1.1115 billion in adjusted net revenue.
Okay.
But the CFO specifically called out that they are intentionally accelerating their marketing expenses in the first half of 2026 and willingly absorbing seasonal payroll taxes in Q1 and Q2.
So they're actively choosing to take on heavier costs right now.
Yes, most publicly traded companies are terrified of missing a quarterly earnings target. They will slash marketing or delay investments just to artificially inflate their profit margins to impress Wall Street for a single news cycle.
We see that all the time.
This company is doing the exact opposite. They are front-loading their financial pain. They're spending heavily on marketing now to guarantee a massive wave of growth and operating leverage in the back half of the year.
They're playing chess while everyone else is playing checkers. I mean, they've built a machine so efficient and a balance sheet so flush with cash that they can afford to absorb heavy costs early on, fully confident that the revenue from those investments will compound later.
It is the ultimate luxury in corporate finance. When your balance sheet is bulletproof, you don't have to manage your business quarter to quarter in a state of panic. You can manage it year to year or even decade to decade.
Which perfectly summarizes this entire journey. We started this deep dive looking for the cash reality hiding behind corporate jargon. And we've seen how this platform uses optionality as a routing engine.
Yep.
Keeping the best high-yield loans on a balance sheet funded by $40 billion in cheap member deposits, while intelligently selling off the riskier layers to global banks. They have engineered a financial fortress.
This raises an important question, though. We have seen how brilliantly this platform has insulated itself from macroeconomic shocks. They perfectly balance retaining profitable loans while offloading risk to eager global institutions. But they do this by catering almost exclusively to a customer base, making over $150,000 a year with prime credit scores.
The super prime borrowers.
Exactly. Are we witnessing the creation of a financial ecosystem that is entirely insulated from the economic pressures facing the average middle-class consumer? If the top tier of borrowers and the top tier of platforms are operating in a closed, highly profitable, risk-free loop, what happens to everyone else when the macro environment gets truly hostile?
That is a fascinating and slightly ominous thought to end on. A dual-track economy where the most well-equipped platforms and their wealthy borrowers just float comfortably above the storm, completely untouched by the realities of high interest rates, while the rest of the market absorbs the impact.
It's definitely something to think about.
It certainly changes how you will read the next boring corporate transcript. Once you understand the mechanics, the muddy diagnostic waters clear up, and you see the underlying architecture plain as day. Thank you for joining us as we unpack this financial machine. Keep that question in mind the next time you hear about interest rates staying high, and we'll see you on the next deep dive.